Welcome back to Strong Band Personal Finance, everybody. My name is Christopher Belly. I'm a certified CPA accountant. I'm a long-term boglehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. And I just had a wonderful freaking experience while I was at the gym. So there I was. I just finished a bench press. You know, I was repping 500 pounds 10 times. And then I checked my phone. And what do I see? Honest but honest! So, as you saw in the intro, Honest is down like 20%. Their stock has been freaking decimated in after hours. Why? Well, we're going to go delve into the financials, and I'm going to give you my honest opinion. Get it? Honest. I'm actually going to give you a legit analysis, or at least, somewhat fair analysis of Honest. Now, before we get into the numbers, let's remember what Honest is all about. Honest sells a bunch of home products. They sell like lotion and diapers and all sorts of generic crap, okay? My reservation about this company, besides being unprofitable, massively unprofitable, I haven't even seen the numbers recently, is that there's no moat to this company besides Jessica Alba. Jessica Alba is your moat. So Jessica Alba is the founder. I don't know if she actually runs the company day to day. I highly doubt that. But she's the face of the company. And I really suspect, and I'm not joking here, Jeremy likes this company because he thinks Jessica Alba is hot. I am not lying. I am not joking. I'm being dead freaking serious. She's not bad, My wife's more beautiful, but, she's not bad. So, this is the Honest website. So here are the leaders. We got Nick Valos, Kelly Kennedy, Rick Rexing, Don Frey, and Janice Hoyt, Chief People Officer. I want that job. All right, let's go look at the financials. The Honest Company reports fourth quarter and full year 2021 financial results. Combined core category revenue of diapers, wipes, and skin personal care increased 19%. Wow. Full year core category growth increased 13%. So we see some revenue growth here. Now let's look at a little bit more of the numbers. Revenue overall increased 3% to $80.4 million for the fourth quarter compared to the fourth quarter last year. Now look, ladies and gentlemen, one of the big selling points on Jeremy's stocks is that they're growth companies. Their revenue is growing extremely quickly, blah, 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 blah. And he doesn't seem to care about profitability. It's all about how fast can the revenue grow, because eventually the profitability will just figure itself out. Companies don't go out of business. Now, to see a company get a 3% revenue increase year over year, a growth company, that's freaking horrible, okay? I don't see any justification to own this stock, even as a growth stock, if they only grew 3% year over freaking year, okay? Well, they try to make it look better because they're like, oh, revenue grew 3% from year over year, but it grew by 26% over 2 years. So that's, I guess roughly compounded, probably 12%, 13%. Not that impressive for a growth company, right? The increase in revenue for the fourth quarter compared to last year was primarily a result of strong volume growth in our skin and personal care and diapers and wipes, none of which have a moat, okay? There's nothing special about Honest wipes versus every other wipe. And I can tell you that Honest products are not that special. My wife betrayed me and went and bought some Honest lotion. It's freaking lotion. Wow. I used it on my kid, and then we didn't buy it again because I can get cheaper lotion at Walmart. But they're so liberal and amazing. It's Jessica Alba. So let's look and see some of the revenues disaggregated. Because you can't look at a company and just look at the total top line revenue. You can, but there's also subcategories of revenue in the company. Now, if you look, they've broken it down into diapers and wipes, skin and personal care, and household and wellness. Now, oh my God. So, starting with diapers and wipes. Diapers and wipes over the last year has grown 16%. Wow. All those babies being born. COVID babies. Skin and personal care, 26%. Which is 19%. Household and wellness, down 68 freaking percent. Now, one positive thing, I guess, is that the household and wellness was not a massive part of their revenues in 2020. And it decreased massively, but it looks like the biggest source of revenue is diapers and wipes. And it increased by 16%, and skin and personal care, a decent sized portion of the revenue, increased by 26%. I don't know what happened with household and wellness, but that's what really drug the numbers down. But you at least do have positive signs of growth in diapers and wipes and skin and personal care, okay? Which I'm sure Jeremy will highlight. Now, let's see why household and wellness went down. Revenue from household and wellness, which represents 6% of total fourth quarter revenue, declined $9.7 million as a result of reduced COVID-19 related consumer demand for sanitizing and disinfecting products and face masks. Okay, let's see. Digital. Now, here we have fourth quarter revenue by channel. So I guess they have retail sales, which I think they have them in like CVS's or Walgreens, and I don't know, do they have them in Walmart? I haven't seen them in Walmart. But their digital sales increased by 70%, and their retail sales decreased by 8%. Now, it looks like they're roughly neck and neck. So I don't know if they're purposely shifting towards making digital revenues a larger portion of their company. I don't know if that's intentional or if this is a problem with them, getting exposure in retail. I really couldn't tell you. All right, let's go down a little bit more. Gross margin, which is, and I always say this, the gross margin, you take your revenue minus your cost of sales. That's just the cost of making the items or buying the items if you don't manufacture. And you subtract that and you get your gross margin, okay? Your gross margin is towards the top of the income statement. You still have other expenses besides your cost of sales. You got to pay the CEO, you got to pay the sales staff. You got all sorts of stuff, that interest, taxes, there's all sorts of stuff that affects your profitability before you get to the bottom line. Now, gross margin was 30% this year in the fourth quarter compared to 33.6% in the fourth quarter. Now, why did this happen? It was because of increased inventory reserves related to certain sanitizing and disinfecting products following declined COVID-19 related demand, combined with significantly higher costs of raw materials, transportation, and warehousing. Now, when it comes to cost of goods sold, you actually have to capitalize the cost of buying the inventory, shipping the inventory to you, and all sorts of stuff. All that gets capitalized in the inventory. So if costs increase, if shipping costs increase, if material costs increase, that's going to increase your cost of goods sold when you actually sell the product, which is what decreases gross margin. So, it's not surprising. We have inflation, blah, 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 blah. And, that's not a massive decline, but, that's not a positive sign either. Operating expenses were 40% of revenue in the fourth quarter of 2021 compared to not 49% of revenue in the fourth quarter of 2020. So if you have a gross margin of 30%, and then you have operating revenues are 40%, before interest and taxes, they have a negative 10% loss, roughly. So the reduction was driven by decreased selling general administrative expense, primarily due to certain non-recurring costs related to our initial public offering incurred in the fourth quarter of 2020. Marketing spending increased slightly driven by investment. Okay, blah, 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 blah. Net loss for the fourth quarter was $9 million. They lost $9 million in one quarter, compared to a net loss of $12 million in the fourth quarter of 2020. So they at least got better at not losing money, right? Let's see. Adjusted EBITDA. I don't even look at that crap. Business highlights. Achieved higher market share in our scene. Now, here's where they're going to try to hype up everything about the company. But, they're trying to compensate for their insanely slow revenue growth, which is not good for a growth company, all right? That doesn't mean a company's worthless because they have slow revenue growth. Even a company that has declining revenues can be a good investment as long as you're, actually buying it at a good price. The problem with this company is they're unprofitable. I've been saying it over and over and over again. If you buy an unprofitable company, you're gambling. You're praying they become profitable at some time in the future, and then you're praying a bunch of other people come in later on once it becomes profitable and elevate the stock price. It may happen, or it may not. But the company is losing money every single freaking quarter. So when you buy a share of ownership, they're probably going to dilute you because they're losing money, and you're losing freaking money. It's freaking crazy, okay? It's not worth the risk. So we achieved higher market share in our core categories as our retail consumption outpaced category growth based on third-party consumption data. Honest diapers, wipes, and baby personal care Grew by 11, 7, and 10%. Wow. Okay, so they significantly outpaced the product categories in the industry as a whole. Now, that's not a positive. Basically, what they're saying is their sales of specific items grew faster than the industry as a whole. That's not surprising because they're a smaller company and they're more of a growth company. So just because their sales grew faster doesn't mean that's a good thing compared to the industry. You can't compare this company to the industry as a whole because they're so much smaller. Of course, they're going to have higher percentage growth rates than freaking a more established company. That doesn't mean anything. Introduce consumer-centric marketing campaigns. All right, crap. Expanded distribution to over 43,000 retail locations. Well, didn't they freaking... Okay, so they expanded distribution, but aren't their retail revenues decreasing? Let's see. Digital revenues up 17%, retail down 8%. So here, this first comment, complete BS. Okay, they're a smaller company. They're going to grow faster. Consumer-centric marketing campaigns. Doesn't mean anything. Expanded distribution. Well, their freaking retail revenues declined. And we expanded our ESG efforts. Wow. So all of these freaking bullets don't mean jack crap. They're all freaking BS. Let's see. Full year results. Now, for the full year, this isn't quarter over quarter, revenue grew 6%. That's not good. Okay? This is supposed to be a growth company. Gross margin decreased by 1.6%. Okay? Operating expenses increased. That's not good. Primarily related to non-recurring costs related to our IPO. So, I mean, that could be a one-time charge, but I wonder what the operating expenses would be after that non-recurring charge. Net loss was $38 million compared to a net loss of $14 million. Wow, that's freaking amazing. Once again, related to a non-recurring cost related to our IPO. So, I mean, like I said, that could be a one-time accounting charge. I don't know what that is, but I mean, I don't know. Do we see any cash flow here? Let's see. Outlook. Full 2022 year revenue is expected to remain approximately flat compared to 2021. First quarter revenue is expected to decline approximately 15% from the first quarter of 2021. Oh my God. Oh my freaking God. This is horrible, okay? The one thing this company had going for it was revenue growth. And now they're saying their revenue is going to be flat. They're going to have flat revenue and they're going to lose freaking money the whole year. What is there to like about this company? Somebody please freaking tell me. God, Jeremy's such an idiot. Let's see. Long-term strategy. We have conviction that our award-winning Honest brand will continue to lead the clean lifestyle. Yeah, it seems like your fans are really buying into that. I don't see anything positive about these results, okay? It's supposed to be a growth company. Revenue is trash. The revenue is going to decline going into the future or remain flat. What the heck is going on here? This is the trashiest company I have ever freaking seen, okay? Or at least something that Jeremy's picked. There's nothing special about this company. They sell freaking diapers. Everybody sells diapers. They sell wipes. Everybody sells wipes. The only thing they have going for them is Jessica Alba. And that didn't freaking work either, okay? This clean liberal BS is crap. So, if you're listening to Jeremy and you really take him seriously after something like this, I don't know what to tell you. I mean, he paints himself as a long-term investor and a genius in picking stocks when he's just a clown and he got freaking lucky at Tesla. Okay, that's the only reason that freaking clown has a following. God. Whatever. Not good. Not good. And even their highlights. Oh, our highlights. Our highlights are all BS. Oh, we're going to be more liberal in ESG. Oh, my God. Anyway, that's it. Time to chill. Because I have to work tomorrow like a loser. Like, subscribe, tell your friends about me, and I'll talk to you later. Cheers!